The question is, where is the U.S. economy right now? We're going to get another prescription coming up on Friday when we get the first quarter GDP numbers. I'll put up a chart here that basically shows that the Atlanta, the New York, and the St. Louis Fed, on their projections, you can see the wide disparity, particularly the white number that's Atlanta, which is shot way up to 2.8%. New York is the blue one, down at 1.4%. The St. Louis sort of only does it every month, so it's a little bit more flat. Why do we have such a wide dispersion in what people are expecting?
I think for this particular quarter, we have a structural problem and we have a data problem. The structural problem is that Q1 is notoriously low. And so the Fed has been working on different data collection strategies. And so this quarter, we may actually have not necessarily apples to apples comparison with the year before. The second thing is that the data has been all over the place. So we've had the horrible retail sales numbers in January and February, only to bounce back pretty dramatically in March. And that makes it very hard actually to calculate because you may not be sure that the numbers are correct. So we think we're between 1.5 to 2% for the quarter. But having said that, I think there are some data measurement problems that we just actually don't know about a priori, and we'll find out on Friday.
Well, that's my question, because you put together what you describe as some real data collection problems that really have the data going all over the place. In the meantime, the markets are incredibly calm, low volatility. So we got a lot of volatility in the data and not much volatility in the markets. That doesn't seem like a good solution.
No, and I mean, look, the markets are calm and there's low volatility because central banks globally are out of the picture. And as you showed from your clips of your other guests, you know, we're kind of in a nice spot because if you can bring in 2% growth and quiet central banks, that in many ways is very good for continuing the expansion and also for markets because you're not getting a blow to it one way or the other. So I don't want to call it Goldilocks because that feels like the moment everything's going to turn if you say it. But there is this sense that slow and steady with quiet central banks actually is a pretty nice prescription.
Well, but to pivot off of David's chart, I mean, these are tracking indexes. These aren't forecasts. They're like, what's reality? And the Atlanta Fed is doing well because of exports. So, like, isn't President Trump right? I mean, isn't that what we're seeing? As we're seeing a better export market, trade deficit is narrowing, and that's actually good for our economy.
Well, also, what we saw is that the consumer bounced back in March. So, look, don't forget, there's been suspicions about the labor market report in February. There's suspicions about the retail sales number at the end of December and January. So there's a sense that maybe it's not quite capturing what's going on. I think what is real is that the 20% sell-off in the fourth quarter had a real detrimental effect on the economy in the first quarter of 2019. And I think that's definitely filtering its way through. And as time goes on and the markets reverse themselves, that will dissipate. But I think there's no way, you can't escape what happened in the fourth quarter and how it affects the real economy, because households are now more exposed to equities than they are to real estate for the first time since the late 90s, and the Fed knows that. So there was a real quashing of economic activity in the first quarter.